Welcome to SaaS Backwards, a podcast that helps SaaS and AI company CEOs and go-to-market leaders accelerate growth and enhance profitability. Our guest today is Melanie Nabar, Vice President on the software team at Volition Capital, a growth equity firm that takes a concentrated approach to investing in high-potential founder-owned companies. Welcome to the podcast.
Thanks for having me, Ken. Excited to be here.
Yeah, we're thrilled to dig deep on this topic. Funding is so important to the growth of SaaS and AI software companies. But before we dig in our episode, could you please tell us a little bit about yourself that I might not get from LinkedIn and about your company, Volition Capital?
Yeah, absolutely. So myself, I'm a Massachusetts native. My dad actually grew up a street over from where I grew up. So I am born and bred through and through here. I now live in Boston. I've been here for about 10 years with my husband and my golden retriever. Probably find me on the weekend running along the Southie Beach with her and letting her kind of frolic around in the water. I am currently Vice President, as you mentioned, at Volition Capital. We are a growth equity firm based in Boston. We essentially come in when companies are past product market fit and looking to have a partner to help accelerate their growth, or sometimes take some chips off the table just to make life a little easier as a founder. We take a concentrated approach to investing. So it's not the, hey, we just need one company out of 50 to succeed in a fund. We only invest in 15 to 20. So we need all of them to succeed. And with that, it tends to mimic our risk profile on the downside, while also making sure that we're investing in people with really big visions, because you only have 15 to 20 shots on the goal.
Well, thanks for that. I do have a question for you. You said you're Boston native, born and bred, but how'd you shed the accent?
My dad does have an accent. My mom actually doesn't. I'm not sure. I guess she must have taken efforts when I was young to make sure I didn't have the drawl. Maybe if you give me a beer, it'll come out.
Fair enough. Well, I want to dig into the topic at hand. So why don't we get going? So the first question really is, when is growth equity the right fit for a B2B SaaS company versus venture or traditional PE? For a $25 to $25 million in ARR founder, what signals should they be looking for to say they're ready? What do they need to be ready? And what do first-time founders misunderstand most about the model? That's like a 5-part question. Sorry.
I will start with the last one in terms of what sometimes folks misunderstand, because I think it leads into when growth equity is a good fit. Overall, I find half of founders know about growth equity and are super educated on that front. And the other half have heard of venture capital and have heard of private equity buyout models, but aren't really aware that there's another option that's somewhere in the middle. Venture capital tends to be earlier stage. So companies that, hey, maybe it's an idea, or maybe you have a few customers that really like it. And with it, there's really high risk in terms of the business. So that means from an investor incentive perspective, you need to invest in a ton of companies. Your portfolio needs to be incredibly diversified because the risk profile is high. And with that, it also means that the incentives of venture capital firms, when they are investors, is to focus on the winners, because that is where the power law would tell you that most of the returns are going to come from. And there's lots of great venture capital firms out there that are wonderful at this and are good people. And then on the other end of the spectrum, there's private equity, which for the most part is majority, where somebody's coming in and buying a majority of the business. It could be a great option for founders who are looking to liquidate a good chunk of the business, or hey, I built the business to XYZ stage and I want to go back and start another company. This is not, now this is becoming bureaucratic and this isn't what I want to do. Often folks will recap. Sometimes private equity gets a bad rep because founders don't want to give up control of the business. And founders also sometimes think of like, oh, you're going to put a bunch of debt onto my balance sheet. You're going to let go of a bunch of people to focus on profitability, which Sometimes it's true, sometimes it's not, depends on the private equity firm. But I'd say like later stage, giving up control is private equity. Growth equity is somewhere in between. The companies that growth equity firms are investing in are real businesses. They have a bunch of customers. They have some semblance of a repeatable sales motion, who actually uses the product, an understanding of how they appreciate or don't appreciate the use cases. And typically, growth equity firms are also coming in as minority investors. So you're not coming in and trying to run the business. And oftentimes, folks also only think you can put capital onto the balance sheet to drive growth. You actually sometimes can just take a few chips off the table. We do that a lot as well, where if you're a first-time founder and all of your net worth is tied up into this business, you've done a great job getting it to 10 million in ARR. You have a lot of theoretical net worth, but maybe you're trying to send your kid to college, or maybe you want to pay off your mortgage. So a lot of times when we come in, we'll also write a portion that is secondary to kind of de-risk folks' personal lives so they can think clearly about the risks and rewards of taking certain moves within the business. So that's a broad explanation of the different realms. And I think just the existence of growth equity as an option is something some founders don't know about. In terms of what's the right fit for a company, I'd say, one, it depends on what you're looking for in an investor. And then two, it depends on the stage of the business. So if you are a 20 million in ARR business growing nicely, you're probably not a fit for a seed stage, venture firm. You're probably too big, because venture firms are looking for 10x, 20x, 30x potential in terms of growth. And there are businesses out there that are 20 million in ARR and have that potential, but it is a lot harder to 20x when you're 20 million in ARR versus 1 million, right? And then the other piece of the puzzle is what you are looking for as a person. Do you want to give up control? If you don't, then private equity is probably not a fit. And then do you want a partner who is going to be involved in some way, not controlling the business, but trying to help you along the way? Or do you want to be one of many in a portfolio where you're really left alone entirely? So if you're looking for the latter, maybe venture capital is the right bet. If you're looking for the former, growth equity could be a fit. It's just important to understand and be aligned to what the fund you're working with is expecting. Because if you are one in 50 companies in a portfolio and you only matter if you 20x, then your board member may push you to take bigger risks. And maybe you want to take those risks. Maybe that is the model, and that is totally fine. Maybe it matches your ambitions. But if you don't want that, you just should think about the construct of the funds you're working with so that you're aligned with the folks that are on your board and on your cap table.
Yeah, I think that kind of point of view or preference of the investor is something that isn't revealed a lot. I mean, it must come through at some point in the conversations, you would hope, before the check is signed.
Yeah. Yeah.
But I think growth equity sounds like it, for some founders, could really be a Goldilocks kind of solution where they get the capital they need to take their next steps, whether it's accelerate growth or de-risk their personal lives or both. And yet they don't give up the control, right? So they still own the business and still have the ability to kind of chart the future.
I like to think so, but I am a biased source, of course.
Well, we're not doing investigative journalism here, so you're going to have to make your own choices out there in listener land. I want to kind of move on, but I touched on it very briefly before about scale up. And I think that, scale up is the thing you try and do right after you have product market fit and you're starting to build your organization. You're looking to do different things than what you might have been doing 3 or 6 months earlier. And I'm wondering what the handful of scale up mistakes you guys see kind of repeatedly, especially around go to market. And I think when we did our prep session, you mentioned one of them was promoting the top performing sales rep to head of sales. So what are the mistakes you see, and how do you diagnose those things?
Yeah, it's a great question. There are patterns that happen over and over again, and there are always exceptions to the rule. So I will give you what I've seen as mistakes, but hey, if you're a founder and you have conviction, it's still the right choice. That is something you should do. The first mistake you mentioned is, taking your best sales rep and making them your head of sales. It can work. It is just a bigger risk because typically when you are finding product market fit and heading towards the scale up phase, you often have one rep that is producing a vast majority of your new business every year. It's very common at that phase. And if you take that person and you make them a manager, two things can happen. One, they may not be a good manager. They're a great sales rep, but they may not be a good manager. Two, if they aren't able to scale the team like you're hoping, you not only are having new reps that aren't productive, you're also not booking new business because that rep is busy, right? Managing. It takes a lot of effort to manage folks. So it can work. There are exceptions. Of course, every head of sales out there was at one point a sales rep, right? So it works sometimes, but it tends to be a bigger risk than bringing in a head of sales who's kind of already done that role. The second thing I see people do quite a bit is experiment too much all at once. In my opinion, part of the reason you raise capital is because you have theories on, if I could take this capital and I could do XYZ, I could grow the business to an outsized place, of course. That's why you take it. And so experimenting is a big part of the use of capital. However, if you do it all at once, a few things happen. One, you burn too much cash and you cannot get cash back once you've burned it. And two, you end up in a place where you actually don't know which of the experiments work. And you end up with a bloated organization around those experiments. So maybe you're letting folks down because you overhired and now you have to let folks go. And two, you didn't actually get what you wanted out of the experiment in terms of learning, what should I double down on? So that's something I think people often do once they've raised capital, is they double down on too many things at once and then they can't tell where to focus. And then the other thing that I would say on the flip side, sometimes people do is you've raised capital, maybe you're a bootstrap founder, and it's not in your DNA to burn. It's not in your DNA to spend the capital. There's no reason to give away a piece of your pie if you're not going to use that capital to drive a heck of a lot bigger pie. And so I think sometimes founders are afraid of kind of dipping into the burn. And I would say it's really, I view it as, part of my job when I'm on a board to essentially push on whichever side is happening, right? If somebody is hesitant to burn, I'm making sure I'm asking questions around like, what is working? Like, why wouldn't it work to double down? Like, let's play out the scenarios. If somebody's ready to do too much at once, I'll say, hey, why don't we think about doing this first? If it works, then absolutely, let's double down. But let's get some information along the way so that you get to play all 9 innings of the game. That's the goal. You want to play all 9 innings. And if you burn everything in the first, then you don't get to. So I'd say those are 3 of the biggest areas where I see folks trip when they're scaling up. And none of those mistakes can't be righted along the way, but they're fairly common.
Yeah, I think the promoting the best sales rep to manager, I think also comes from maybe a misunderstanding about what that rep might want to do with his or her career. If they're a great salesperson and they're making serious dough, they want to keep on that track, and you might push someone into a role they really don't want, never mind not their strong suit. And I think you're missing the opportunity to recruit someone who's a star at the manager role, right? The head of sales role, which is, if you have someone that's got a demonstrated track record of being able to build and motivate a team to the goals, that person will be a big add to your team. So you're not adding where the most transform is possible, I think. So that's a really important one in my mind, and it's easy to do that.
Yeah. If you're doing it right, then the highest paid person at your company is your best sales rep, more than the founder, CEO, etc. That is critical. Of course, hopefully the founder owns majority of the business, but in terms of, typical operational compensation. That's what you want.
Yeah, you want people making better part of $1 million for you because they're making it 8 or 10, right? So
Yeah.
they're really hitting it hard. I think the thing I've noticed from my own experience, and I like you've seen a lot of these young companies, is I sort of do my own pattern recognition. I can see things that are clear to me. Hopefully, I'm seeing reality, but I'm wondering, like, what are the things that you can see quickly that might not be apparent to a founder that either really encourage you or have you seeing maybe there's a motion or a people issue, and it could be people issue might be just not enough staff or like the wrong person in the wrong seat. So is there stuff that you start with, like your rules of thumb?
As I connect this to kind of the scaling question, I think there are definitely rules of thumb for thinking about when you should turn the switch on in different segments or adjust accordingly. One of the big ones is around like sales and marketing spend. So I often look at sales, and if I say, this is for a SaaS business with, good recurring revenue, if a sales rep's comp, if they're booking 3 times their total comp, income and commissions, then that tells me anything above that, and I'm saying we need more reps. We're leaving money on the table. I also tend to look at more qualitatively, like how much time is your rep spending on a demo, on a call every day? If they're spending, less than 75% of their time, then a BDR could potentially be a good option to make sure you're filling their schedule. Like that would be a trigger point where that person's schedule is not full enough. Or you need to invest more heavily in sales and marketing. You always want to be investing in lead generation a few months ahead of expecting a new rep to be productive, so you kind of can hire them or think about investing in tandem. The other trigger point I think about is next year, what do you need to do in order to double your new bookings? Because anything you do within a calendar year doesn't make a difference to that calendar year, not substantially, right? So you always want to be thinking a full year ahead in terms of kind of scaling those organizations. It's fairly common for capital efficient founders who, at Volition, we love capital efficiency. We don't believe in the burn at all costs and risk it all model. It's fairly common to think like, all right, we're going to hit our numbers next quarter and the quarter after, so I feel good. We don't need to hire any new sales reps. But you have to think about your ramp time. You have to think about your lead generation time and kind of back into that math, because in a growing company, every single quarter needs to be the best quarter you've ever had, right? And that gets harder and harder as you get bigger and bigger, especially if you're behind the 8 ball on kind of hitting those trigger points.
Yeah, I think that's probably the hardest thing across the board for the founders that I've worked with. They're not looking a year out or 18 months out. Certainly not. It's not their comfortable place, right? Their comfortable place is usually operational and focused on this quarter, next quarter. Even before they have investors, they just can't see that far or think they can't see that far into the future. Speaking of those kind of investments, can you tell our listeners what, from your perspective, a repeatable motion looks like? So, we've talked about growing the sales team, but before we do that, like, what do we have to be sure we have? Like, what has to be in place before we go hire, double the size or triple the size of our sales team?
I wouldn't recommend tripling the size of the sales team before you understand what an ideal rep is. I think that's one piece of the repeatable motion that's important. Often there's 1 or 2 reps, as we discussed, that are producing most of your new bookings when you're a young business. And so first you have to figure out, can you replicate those people? And so I wouldn't suggest going out and doubling your sales team if you only have 1 in 5 people that are producing, because you probably haven't figured out how to hire the right people. And most likely, maybe you get 1 more winner, but you're probably going to have the same results if you don't change the inputs. That's one piece of kind of the repeatable motion I'd think about. I would also think about the types of customers you're selling into. So to me, it's not a repeatable motion if you've won one enterprise contract that's driving your growth, but your SMB motion is still most of your revenue, and that motion has not been capital efficient to date. I think one mistake a lot of founders fall into, or sales leaders fall into, is you have some success with the enterprise and you let all of your reps do both. Because then what happens is people are chasing whales and you actually don't have a good sense of within the period of time or what are you going to book. I think you really need to kind of bifurcate that. So understanding your ideal customer is really important to building that repeatable motion. And then of course there's just logical consistency, right? You've had a few quarters in a row where you've added more revenue than the last quarter. Like that's a great signal that probably means it's working and you need to double down. There's typical KPIs like how fast are you being paid back on your sales and marketing spend? If customers are sticking around for 5 years typically and you're getting paid back in 1, all right, let's double down on that because we're going to be quite profitable going forward, and there's no reason why we shouldn't be able to continue to grow at that pace or more quickly.
Yeah, like the capitalizing revenue part is one of the things I think founders don't often appreciate. You know, they understand how long it takes them to pay back, but they don't understand how much money they're going to need to fund the growth, right? If we're waiting a year, we got to fund a whole year of whatever that cost was. So you have a limit, you have a gate limiter right there. When we talked before, we talked about sort of like the first 90 days after funding, right? And could you sort of share like what the outline of a 90-day plan after funding looks like to you?
Yeah, absolutely. I will say at Volition, we're not big like playbook style investors. So I don't think that there is like, here's the magic playbook. It worked for one of my companies, so it has to work for you. So the plan varies based on the company and the business model and the folks and their preferences for how they want to run their business. But if I think about a good first 90 days of investment, it's really, if we've done it right, most of our diligence period was spent on understanding the levers of the business. We want to make sure that as board members, we understand what's driving the business, what are the risks in our motion, so that once we're on the board and involved, we can actually be helpful because we don't have to be educated along the way. So hopefully I'm starting that 90 days and we have a really good sense of those levers. And then I think it's really about agreeing on what are the few things we need to do in the next year for us to be successful in the following year and beyond. There's probably a list of 30 things you could be doing that would hopefully help you grow, but agreeing on like which ones will be the most impactful and keeping that to a very limited number is really important. The other piece of having a board, which about half of the companies we invest in are bootstrapped, so they've never had a board meeting before. I think a big piece of the value in those board meetings and in having a board is that when you're running day to day to make things happen, you're not always taking the time to think about the strategic moments and whether or not a company or a founder ever decides to raise capital. I think it's good practice to, whether it's once a month or once a quarter, sit down and like think about what are those strategic initiatives you decided on and how are you measuring up against those strategic initiatives. Maybe one of them is not relevant anymore. Great, let's decide that and move on. But I think making sure that in the first 90 days, we have a really good plan of what's important. And again, we're not my majority investors, so we're not going to say this has to be the plan. We just need there to be a plan and thoughtful discussion around like what are those strategic initiatives.
Yeah, I think that it's important maybe to just take a moment here and talk about the relationship between an investor and a founder, right? I mean, this is in the healthy relationship is one where they're really mutually supportive, right? And the founder's drawing on your experience, perspective, resources to improve their odds of getting where they want to go. Can you just give a little bit of color to that? Because in our prep, you talked pretty eloquently about that.
Yeah. I mean, taking an investor is not a small decision. A lot of times folks will ask me, founders will ask, what's the differentiation between Volition and XYZ other growth equity firm? And there's lots of things I could list, our approach, value-added resources, etc. But at the end of the day, it really matters like the people you are deciding to bring into your cap table and onto your board. Because once a person is on there, they are on there. It is just as important as a marriage. In order to get out, you need to recap the business or sell it. And that may not be the right time at any given moment. So I think it's a really important relationship, which may seem obvious, but just underlining that. And I think it has to be one where you need to understand each other's incentives. You need to understand what a win is for your investors. You need to understand where you sit within their portfolio. Small things, or what might seem like a small thing of, hey, are you the last investment in a fund that's not doing very well? Because that's a lot of pressure. You're a kick-save portfolio company, and that is a lot of pressure. And there might be risks that your board member is pushing you to take that otherwise you wouldn't. These are things that founders don't always ask about that are really important. So understanding incentives. And then you want to feel like there is respect enough that you can disagree. Again, my practice has been minority investing, so I may not agree with something, and that may still be how the founder decides to do it. And that's fine, because I am hoping that the founders that I'm backing, that's who I believe has the best decision-making for a company. And it's really more about pressure testing. For me, I think about the role of a board member as pressure testing your conviction and making sure that you're seeing the forest within the trees. So it's really about asking questions and kind of enabling the founder to ultimately make those decisions for themselves, but make sure that you're seeing around the corner. And if one of my portfolio companies decides they want to hire their best sales rep as their head of sales, I'm just going to ask questions around that. Hey, how are we going to backfill their quota? Do we feel good about the existing reps? How quickly are we going to make that decision? Making sure we're really thinking it through, because ultimately it is the founder's call. And I think that is the benefit of working with that board members who are pretty much always minority investors, right? Like that's the muscle memory.
You mentioned earlier that like many of these firms, they've never had a board before. It might be good to touch very briefly on like, how do you kick off that relationship? What does the start of a board of directors relationship with an investor look like? And, what makes you guys feel comfortable in those early days?
Yeah. It starts before the investment. You can read a lot into how your board will interact with you from the diligence period. I am very big on sharing back all of the analyses we do during diligence and getting live feedback from founders on, hey, we're in this little black box looking at all of your information. Is this qualitatively actually what's happening? And how do you think about it? So I think you're going to get a good sense of how open your investors will be during diligence. And you should talk about some of how they view the strategic initiatives. And you should ask to talk to their other portfolio companies to make sure you're getting a firsthand view. It's not a one-way diligence street. The founders should be diligencing the investors as well. And then once we made it official, wired the money, etc., a lot of times if a team has never done a board meeting before, we'll kind of put together, here's like a high level outline of what we typically see during board meetings. And we'll sit down with the founders and talk through like, how would you measure sales momentum? How would you measure marketing momentum? How would you measure your product initiatives to make sure that you're not trying to fit a, square peg through a round hole, essentially. So we try to be pretty collaborative on giving some education on like what is usually in a board meeting. And I think agreeing on KPIs is a big piece of what needs to be prepped to figure out what is important for the board meeting. Like, how do you want to measure your success and how do you measure your business? And then board meetings sound very official and scary. And yes, you take minutes, which also sounds very official, but at the end of the day, in most of our board meetings, yes, there's a deck and there's data shared, but it ends up being a strategic conversation on like what's working, what's not working, where could we help, where do you have conviction, where are you not so sure about your decisions, and really ends up being a little bit more of a broader forum than I think people expect it to be.
That's great for people that haven't had that experience. I appreciate that perspective. So I want to ask you the one bonus question. AI it's like peak AI, right? I mean, everything's AI.
Yes.
My refrigerator is AI. So, but I want to know what you think is truly investable in B2B, where it goes beyond, wrapping prompts in a user interface. What are you guys looking for that separates like a real product from kind of a toy? If you have ideas for people that are looking for go-to-market tech, like where you think go-to-market is going to be most influenced, that's a lot of what we cover on the podcast. So if you have any perspective there, that would be very valuable.
I think as we are trying to navigate this new world of AI, it is not dissimilar from other refresh cycles historically. Every time there is a big technology boom, which I would say that we are in, it is because there's been a massive advancement in what is capable from a hardware perspective, a processing perspective, an infrastructure perspective. So the last one was really cloud computing, right? And now we're in kind of the AI world. I do believe that this shift is that big. I think as we are trying to navigate investing in AI companies, there are companies out there that are exploding from 0 to 10 in 3 months. And normally we come in when folks are about that scale. So it's a little bit different because there's no history. It's 3 months of, this product being launched. So I think as we're trying to figure out product market fit, it's no longer just revenue. It's also repeatable customers and customers seeing ROI from the platform. And that measurement has changed a little bit from just a line in the sand of scale. Technologies that are the most interesting to me are truly platforms where they're providing a value in and of themselves by integrating different systems, by completing a certain workflow and helping folks to complete those workflows. And the most interesting companies from an AI perspective to me are using AI to make that experience to better, to make the value they were providing stronger. I think that tools, when it comes to like, oh, this tool is doing this one small thing, we're struggling with those a bit more just because you can develop so quickly with AI. And if you are not ingrained into somebody's workflow or in the background of a business's operations, then it's very easy to rip and replace. And the reality is OpenAI is moving really quickly, Perplexity, et cetera, where there are certain tools out there that might be growing really quickly that you can almost solve with the open platform. And that is a threat that we think about. There is so much you can do now and go to market with AI, whether you're, paying for a platform or using even just enterprise ChatGPT. I think that go-to-market leaders need to be forcing their team to learn how do you build your own agent? Like, all right, use Clay, connect your data sources. Like, what is a painful part of your job? Like, all of that should be solved via AI, and whether you're using an off-the-shelf platform or kind of cobbling together your specific workflow. If go-to-market leaders are doing it right, sales reps are doing the job of people. Sales reps are on the phone selling the whole time, logging in a CRM, sending follow-up emails. All of these other components can really be handled by AI in the background. So I think the future of go-to-market is let people do what people do best, connect, really be able to sell and explain the value. I think people are still very important for that, but get rid of all the parts of the job that are monotonous and boring. And I think AI can take that over just in terms of go-to-market efficiency. I think it's going to have a huge impact and should hopefully make people like their jobs more. I don't know a sales rep that likes updating their CRM.
I've never met one. They're not good at selling if that's what they like to do.
Yes. Yeah. In the wrong field, if that's true.
Yeah, totally. The vision you have of, create your own agent, I think is a really cool idea. That brought up in my mind the possible career of sort of the agent builder within these organizations. We have these rev ops and marketing ops people.
Oh, yeah.
Maybe a skill for those folks to build for themselves is the AI agent builder, because a lot of that stuff that they do, they could make agents for themselves and then make agents for the sales reps and BDRs as well.
Absolutely.
Hey, I think this is a great place to land our episode. Thanks so very much, Melanie. If folks want to learn more about Volition or be in touch, what's the best way for them to do that?
Yeah, if they'd like to learn more about Volition, they can send me an email. My email is on our website, but it's also Melanie and then the letter N, like no, at volitioncapital.com.
Great. And the website is a fantastic resource to learn about your firm. And I think you have some engagement opportunities on there as well for founders. If people want to learn more about my advertising and demand generation firm for software as a service and AI companies, we are Austin Lawrence Group, austinlawrence.com. That's Lawrence with a W. I'm on LinkedIn/Ken Lempit. And if you haven't subscribed to the podcast yet, you may do so almost wherever podcasts are distributed. This might be the episode that pushes you over the top. Melanie Nabar, thank you so much for joining us on SaaS Backwards.
Thank you for having me, Ken.